Exchange-traded funds, or ETFs, are a great way for beginners to invest money. They're like a mix of mutual funds, but you can buy and sell them on the stock market. ETFs are simple and flexible, making them a good choice for new investors. In this video, I will explain the basics of investing in ETFs, including how they work and why they're better than traditional investments. Find out why many beginners use ETFs to invest, offering access to different types of assets, low fees, and the chance for steady profits. Learn more about the smart appeal of ETFs in this helpful guide to improve your financial journey. Exchange-traded funds, or ETFs, have been around for nearly 30 years, but their popularity has surged in recent times. Nowadays, you can find ETFs for almost anything, from blockchain and innovation to various themes. But what exactly is an ETF? Think of ETFs as bundles of stocks, commodities, or other assets that bring together investors' money and track a benchmark to gauge how well they're performing. I'm David Jones, the Chief Market Strategist at Capital.com. ETFs are similar to mutual funds, but the key difference is that they are traded on the stock market like regular individual stocks. All ETFs with stocks in their portfolio initially follow a stock market index. At Capital.com, I have analyzed data on the top 100 most popular ETFs to understand how changing market conditions might impact them. However, it's important to note that there isn't just one type of ETF. This asset class comes in various forms, and I didn't include leverage ETFs in my research because they tend to amplify returns. There are several kinds of ETFs, such as index-based, sector-based, and synthetic ETFs. Each of these can be further categorized as either passive or actively managed ETFs. So let's break down the main types. Index-based ETFs. These are the classic passive ETFs. They invest in all stocks in a stock market index, like the S&P 500. The value of these ETFs is tied to the overall performance of the US stock market. The primary advantage is their low cost, as ETFs generally have lower operating expenses compared to actively managed mutual funds. Actively managed ETFs. These ETFs start by selecting an index, similar to index-based ETFs. However, an experienced fund manager steps in to deviate from the index in an attempt to achieve higher returns. They are akin to traditional actively managed funds. Sector-based ETFs. These ETFs invest in a specific sector portfolio, such as energy, healthcare, or technology. The advantage is that investors can easily invest in the ETF, knowing that the stocks are from their chosen sector. However, a drawback is that if the entire sector performs poorly, the ETF will likely follow suit. What are synthetic ETFs? There are also synthetic ETFs. Instead of investing in stocks, this type of portfolio invests in derivatives and swaps. Derivatives are complex financial contracts between two parties, deriving their value from an underlying asset. Swaps are a type of derivative product in which two parties agree to exchange future cash flows from two different underlying assets. Now that you've understood the different types of ETFs, what are the current trends in this market? The ETF market has been growing for the past 2 decades, but has really taken off since 2012. What are the ETF trending markets? From my list of the 100 most popular ETFs based on total trading volume over the past 12 months, the vast majority are in equities. A fifth is focused on bonds, and commodity-based ETFs make up a smaller number. The top performing ETFs in the first 4 months of 2022 were sector-based ETFs, with 4 out of 5 being energy sector funds. Factors such as increased demand for goods after lockdowns and the war in Ukraine contributed to soaring energy and commodity prices, benefiting energy sector ETFs. However, investing in sector-based ETFs doesn't guarantee the outperformance of the stock market. For example, the S&P 500 gained 220% over the past decade, whereas the energy sector delivered only a 70% return. The overperformance of the broad US stock market is attributed to the rally in technology stocks. From the same list of the 100 most popular ETFs, some offered the lowest returns. 2 were Chinese ETFs, and 1 broad-based Russian ETF offered weak returns due to divestment from Russian-owned assets and China's zero-COVID policy slowing its pandemic recovery. One ETF that didn't deliver on its hype in 2021 was the ARK Innovation ETF launched by entrepreneur Cathie Wood. It's a broad-based collection of tech stocks. Cathie Wood, the best manager of 2020 and one of the worst in 2021, faced challenges as the ETFs massively underperformed, losing more than 60% of its original investment over the past 12 months. So, how could traders approach this market? Invest and leave it or hire a fund manager? The answer depends on whether you prefer passive or active management. Before I proceed any further, if you find the video beneficial, please express your support by liking, subscribing, and turn the notification bell on for my channel. Stay tuned for more additional valuable insights, ensuring you don't miss out on future content. What are passive and active ETFs? Passive ETFs, like index-based ones, aim to replicate the performance of a specific index. They're known for lower costs, but don't involve active management decisions. On the other hand, active ETFs, like actively managed ones, involve a fund manager making decisions to deviate from an index in pursuit of higher returns. Active ETFs often have higher fees, but offer the potential for outperformance. In conclusion, it's important for investors to grasp the different types of ETFs and their trends in the expanding world of exchange-traded funds. A passive ETF simply follows the performance of a specific index, reflecting its gains or losses. For instance, an S&P 500 tracker mirrors the returns of the S&P 500 index, which has historically yielded annual returns of 10.5% since 1957. While the SPDR ETF has been tracking the same index since the early 90s and providing similar returns, in the last 12 months, the S&P 500 performed worse than the three most popular actively managed funds. Despite the recent underperformance of the technology sector, which constitutes a significant portion of the US stock market, passive ETFs tracking the market still dominate in terms of daily trading volume. The top 3 ETFs by trading volume follow the S&P 500 and the Nasdaq. This raises the question of whether actively managed ETFs live up to their reputation. A recent study by S&P Research discovered that nearly 80% of actively managed equity funds in the United States underperformed the broad US stock market in 2021. Over 10 years, this figure rises to 86%, and in 20 years, it climbs to 90%. Only a small percentage of funds managed to outperform the S&P, indicating the challenges of active investing in beating the market. While some notable investors like Warren Buffett have achieved remarkable success in beating the stock market, there is another approach. Sector-based ETFs provide a middle ground between active and passive strategies in how their portfolios are constructed. These ETFs expose investors to the risks and potential rewards of a selected sector. For instance, energy sector ETFs have outperformed the stock market by over 50% in the past year. The energy sector has been performing exceptionally well compared to the overall US stock market, mainly due to the significant increase in oil and gas prices. This surge is a result of various factors, including the disruption in the oil and gas supply chain during the pandemic and the recent events surrounding Russia's invasion of Ukraine and subsequent sanctions. In the past 12 months, natural gas prices in the US rose by over 170%, and European natural gas prices saw an increase of more than 300%. However, not all sector-based ETFs have experienced positive results in the past year. The market for ETFs, like any other, can face challenges, and there was a notable decline in ETF investments in April 2022. Factors contributing to this decline include high inflation and the ongoing war in Ukraine, which led to reduced demand, particularly affecting equity ETFs. The ETF market is large and continually expanding, offering a diverse range of products for traders and investors. While it provides opportunities, navigating this market can be complex and may require some time to grasp. The hope is that, with the presented data and principles, more traders will find ETFs easier to understand. Now it's your turn. What are your thoughts on ETFs, and do you have any specific questions? Drop them in the comments below. If you're interested in more helpful content on finance, there's also an insightful video of mine on the things you should avoid if you want to get rich. Thanks for watching.